So I wanted to talk about in general market volatility and this idea that markets don't move in straight lines. And as I said off the top of our show, everybody will tell you, yeah, we know that. We're not, we're knowledgeable enough to know the markets don't go straight up. We know there are a lot of ups and downs. But yet, when the market takes one of those downturns, I can't tell you how many emails, how many calls I get. Is this the start of something bigger? Should we be concerned? Is it time to get a little nervous, take some profit off the table, move into cash or gold or other types of investment ideas that tend to be somewhat defensive or a hedge against what the investor has been doing over the last little while. It's quite interesting. Last year, for example, one of the best years we've seen in the markets for the S&P 500, 2024, back in the springtime, we had a bit of a dip in the markets. And I probably had a half a dozen emails saying, is this something leading to something bigger? Should we be concerned and nervous? And I said, obviously, no. I think this is a blip on the way to bigger things down the road. And obviously, I was correct and we were correct. And the markets really took off in the summer and into the fall and towards the end of this past year. And the markets were fantastic. S&P 500 made over 20% return. TSX made just under 20% return. The NASDAQ almost 30% return. It was a fantastic year. But within the year itself, there were some ups and downs. And what I tend to tell people is these pullbacks or these ups and downs, especially the downs, we give them different names each time. And our first chart actually will show you a lot of the ups and downs. This is the S&P 500 over the last few months. Look at that chart. How many ups and downs do you see in that chart? Yet I will tell you that the S&P 500 for 2025, so just 6 weeks in, 7 weeks in, it's up actually 4% for the year so far. TSX and NASDAQ are up 3.5% for the year so far. If we can make 4% on the markets every 2 months, well, that's a fantastic return. You'd be making about 24% for this year once again. So even though it's a very choppy market and a lot of people may not feel good about what's going on, markets are higher. And don't forget that yes, this is going to be the type of year, in my opinion, that we're going to experience. We're going to experience times where we think things aren't really going anywhere. As I've said to many of you that have asked me, I'm anticipating a 10% return this year, plus or minus, if you're invested in equities or the stock market through mutual funds or individual stocks. Obviously, bonds will be a lot less, low risk bonds. But overall, if you're in the equity or stock market, yeah, I think you can expect somewhere around a 10% rate of return, which means you're going to be making less than 1% a month. Some months you might have a negative number. Some months you might have maybe 2-3%. January was a good start to the year. And it's interesting because it may not feel like things are going well because of the choppiness, but at the end of the year, I think you'll be pleasantly surprised. And what I was getting at before we showed this chart was we call the downtimes different names. Right now, we're calling them tariffs. Tariffs are causing this market to be really jittery and to perhaps pull back. But I can show you other times in history. Our next chart, we can go back to a time back in 2008, 2007, the S&P 500. There it is right there. We call that time the financial crisis. It's a market downturn. We're all saying, oh my goodness, what's going on? Similar to other market downturns, although this name was different. We called this the financial crisis back in 2008 and up until the beginning of 2009. And you can see what happened in 2009. Markets actually practically doubled for investors, for many investors. Our next S&P 500 chart will show you other downtimes that we had other names for. 2020, COVID times, right? Markets pull back because of the pandemic at that time. So once again, we had a good market. 2019 was great. 2020, pull back in the markets, only to see markets surge again after that. 2022, a little bit further right of that little blip there, as you can see on the chart. Well, that was interest rate increase was the culprit here to bring down the markets. Interest rates went higher because inflation went higher. So interest rates had to go higher to basically combat the higher inflation rate. So again, keep in mind all these different times, and these are big pullbacks in the market. We could talk about smaller pullbacks like DeepSeek. Some of you might, I guess, be familiar with that name. DeepSeek, a Chinese company, came out recently and said, well, hey, what do we need with these expensive chips and these, that NVIDIA is making right now? We could use old NVIDIA chips, use less energy, and still produce an AI system that can rival anybody out there, ChatGPT and all the other ones, Gemini and all the others. And this was a company out of China that says they're doing it for a fraction of the cost. So what happened? All the chip makers, NVIDIA, AMD, everybody associated with semiconductors around the world, they took a hit. Some of the other big businesses like, names like Microsoft and Google, they also were affected for a very short period of time because why would they be spending all this money, billions and billions of dollars, 80 billion, 75 billion over the next year? 100 billion is what Amazon's going to spend on AI, on these chips, Blackwell chips, for example, out of NVIDIA, when a small company in China could do the same thing at a fraction of the cost. So the market pulled back. So what was that pullback? I call it the DeepSeek pullback. That was the name of the company. That is the name of the company. So pullbacks have a name to it. And right now, I guess we're experiencing one, and that is called tariffs. But make no mistake about it. Whatever it is, markets go up, they go down. The good news for all of us as investors, they go up a lot longer than they go down. The downtimes tend to be short-lived and sharp. The upturns tend to be longer and they don't go up as fast. So as I've said on this show before, when markets go higher, they take the stairs up, but when they go down, they take the elevator down. And that's really how you want to look at it. Moving to, I guess, the idea that today that market volatility is a lot greater than maybe just 10 years ago. I think that is very true. And I think if you're an investor today, you need to be mindful of that, because if you're going to invest in the stock market, you have to understand that it is normal to see a 5 to 10 to 15, maybe even a 20% drop or gain in a very short period of time, depending on earnings or announcements by a company or something out of the White House or something out of the Federal Reserve or Bank of Canada. These can affect stocks in a very large way. First chart we have here is of a company called AMD, Advanced Micro Devices. And you can see the downturn that they saw in and around February the 4th. Why February the 4th? Well, that's when they reported earnings. They reported record profits, $7.7 billion in revenue, 24% increase year over year. Yet the stock went down by 10%. Looking at the numbers, yes, 9.8% was the number that the stock dropped by. And that's because going forward, the market wasn't too impressed about what they were saying, how much money they were going to make for the next 12 months. They weren't impressed by their data center predictions, how much money they're going to make from AI and their chips. And so AMD sold off. Second, I would say second largest chip maker, well behind NVIDIA, and reported good numbers, but just not good enough. And so maybe 10 years ago, 10, 15 years ago, stock would have fallen 2, 3, 5%. Today, and AMD fell 10%. Our next chart is Merck. Merck experienced this month, and you can see it here by the chart, its biggest one-day decline in the history of the company. The stock actually fell just under 12%. And why did Merck fall? Well, their numbers didn't really impress when they came out also in and around February the 4th. But more importantly, the drug called Gardasil that they're sending, a vaccine that they sent to China, China is no longer buying at this point in time. They've definitely reduced their buying of this drug. And I guess, according to Merck, inventory levels have built up in China. And so Merck is not sending as much of the drug out there. And so, bam, stock fell 12%. As I said, the largest decline for this company in its history. On the flip side, recently we've seen tremendous success. Companies going up by 16%. One of the names is Intel. Yes, Intel, a name that a lot of us would say, Intel, wow, that's a blast from the past, a name from the past, not really doing an awful lot. Well, that is true, but as you can see here, this chart shows that literally overnight or in just 24 hours, stock went up by 16% because Broadcom and Taiwan Semiconductor are rumored to be buying this company, dividing it into two, and each company taking a piece of the business. So in one day, 16% to the upside. Super microcomputer, our next chart. This is a name that, in our last chart for this segment, this is a name that basically they design performance computer systems and services. They work very closely with NVIDIA chips, and it's a name that's been on a tremendous roller coaster ride. They saw their stock price fall sharply when their accounting firm, their auditors, quit on them because they did not report their data in time for the regulators. And so when you have your data not reported on time, and the company that's supposed to report quits, that does not bode well for the company. So we saw their stock price sell off by over 20% in a very short period of time. Well, what has happened recently? They have a new auditor, they have a new accounting firm, and they say they will be able to meet any regulations that have to be met for the company. And what happened? Stock went up, as you can see here, over 16% in a very short period of time. Once again, this is volatility, I believe, 10, 15 years ago, we never would have seen. Company stocks are moving tremendously. And I think a lot of it has to do with this idea that stock market is priced to perfection. There's a lot of information out there for individual investors to parse through, to have access to, either through social media, online. A lot of people, know somebody or are talking about stocks or individual investments or the economy. There's just a lot of things going on out there. Some of it true, some of it not true, and just difficult for individual investors to parse through. So what tends to happen is investors shoot and then ask questions later. So these big movements that I'm showing you, yes, they are very brief and quick, but then cooler heads prevail. And not that the companies snap back right away if it goes down, or if it goes up, comes right back down. But we tend to see a bit of a consolidation period once a stock moves. And of course, investors need to see and hear something to either make the stock go back up again if it's had a big fall. So volatility, in my opinion, is here, and it is here to stay. And it is a lot greater than what we saw years ago. And if you want to be in the stock market and hopefully be eligible to make those returns, 8, 9, 10% on a medium risk portfolio, moderate risk in the stock market, you have to be willing to take the ups and downs. There's just no doubt about that. And as I said, as investors, I think it's important for you to understand this before you move into the stock market in some capacity, whether through individual stocks or mutual funds.